tech company CEO sentenced to 42 months in connection with fraud against his former employer. Between 2011 and 2019, Sunny Moonshine was the CEO of the victim company, which provided data security services to its clients. Within 6 months of his appointment as CEO, Moonshine and others began an approximately 8-year scheme to defraud the victim company. During the scheme, Moonshine, among other things, created an email account in the name of his deceased uncle but controlled by Moonshine. Moonshine, posing as the uncle, used that email account to correspond with the victim company and to obtain payments from the victim company totaling at least approximately $3 million for services that were never provided. These purported services were falsely represented to have been rendered by the uncle as well as others, including a marketing executive, who had met Moonshine in social settings but had never worked for Moonshine or the victim company and had no idea his identity was being used by Moonshine. Moonshine also caused the victim company to issue a $3.5 million check for a purported tax liability, which check Moonshine then deposited into an unauthorized bank account created by Moonshine in the name of the victim company. In addition, Moonshine defrauded the victim company through fraudulent licensing and reseller agreements between the victim company and 2 other companies, the licensing company and the reseller company, respectively. Among other things, Moonshine instructed another individual to set up the reseller company, in the same way as the licensing company, and then helped create and submit fraudulent invoices from the reseller company to the victim company. This type of fraud is called a billing scheme. Simply put, Moonshine 1. Created a fake vendor. 2. Used his position as CEO to create a fake vendor in victim company payment system. 3. Invoiced the victim company from his fake vendor for fake services that did not happen. 4. Directed payment from victim company to fake vendor. The only chance of the scheme being uncovered after the payment is made is during a detailed examination of financial statements that leads to these particular payments. The guidelines for preventing fraud through financial transactions include separation and rotation of duties among individuals involved in the financial process, including order submission, invoice preparation, check handling, and transaction recording. Approval of invoices by an independent individual who does not have authority over ordering goods or services or drawing checks. Implementation of pre-numbered purchase orders to track purchases, ensuring invoices match authorized orders before payment. Conducting random checks on invoices to identify any fictitious entities used for billing schemes. Utilizing pre-approved suppliers with verified mailing addresses to minimize the risk of fraudulent entities. Verifying invoices from non-pre-approved suppliers before payment. Implementing electronic payments to pre-approved bank accounts to prevent check diversion to fraudulent entities. Randomly verifying supplier names and addresses, especially when invoices only provide postal addresses. Auditing purchases from pre-approved suppliers to detect payments to similarly named suppliers, which may indicate fraudulent activity.